Hello, everybody. I want to share an update what we're seeing in the market this week. Obviously, last week we saw extreme volatility, margin calls, MBS, huge swings, 200 to 300 points in different directions on a daily basis. And by the end of the week, we saw the collapse of the non-QM market, which obviously took everybody by surprise. This week, we're seeing a different kind of volatility, and we're also seeing the other shoe drop, or the next shoe drop, and that's really in the government lending space. So Ginnie Mae backed securities are very much under stress right now, and what we're seeing is the companies that typically purchase MSR servicing from independent mortgage bankers in the government lending space are completely removing themselves from the space. They are not buying, they're not placing bids, and they're not participating in bidding on MSR servicing from independent mortgage bankers that are trying to sell that servicing. The impact that it's having is pretty big. So who are these companies? The big players in the government space are Lakeview, Two Harbors, Pangora, PennyMac. Those are the typical big names that are always acquiring government servicing. And with them not being in the market, the pressure that puts on independent mortgage bankers, whether they're wholesale or retail, is that, if you can't sell that servicing, then you can only hold it. And if you can only hold it, you have increased risk, because the reason why the servicers are getting out or backing out of space right now is concerns over elevated default, because of the fact that unemployment is rising, people are losing their jobs, incomes are under stress. And the first thing to go is the mortgage payment. And in the government lending world, if the consumer doesn't make their payment, the servicer has to make the payment. The owner of that security has to make their payment, which becomes a major cash flow drain if you see a huge spike in defaults. So as an originator or independent mortgage banker, the only choice that you have is, if I can't sell the servicing, I have to limit my exposure to that market. So what you're going to see next is it's going to happen. It might happen with certain lenders faster, it might happen with other lenders slower. But just understand, it's going to happen. Just like I told everybody last week, the non-QM market was evaporating, and that within a week to 10 days that it would be completely gone. Same situation here. You're going to see everything below 640 credit score start to dry up. Lenders are not going to want that exposure, okay, because that's the highest risk for default. You're going to see the high DTI stuff start to dry up, meaning anything above 40%, 45%. Consider it gone, consider it going away. It's going to happen. And you're definitely going to see lenders just systematically decrease their exposure to that market. And it's going to be very impactful to the purchase market. It's going to be very impactful to consumers. But what I'm trying to tell you right now is this is going to happen. There's nothing you can do about it. There's no federal intervention. There's no stimulus. There's nothing that currently is in the works that would actually address this issue. Anything that's going to happen at this point would require a massive overhaul of Ginnie Mae and the way these securities are positioned, and that's not going to happen in the short term. So with that said, just expect changes, expect overlays on underwriting, expect higher pricing hits on tiers, on credit tiers, lower debt to income ratio requirements. It's going to happen. It's going to happen very soon. Next thing I want everybody to think about is you're going to start seeing lenders require loans, not just loans in shelter-in-place areas, but loans, period, to either be an underwriting status, approved, clear to close, or some type of late in the process disposition before they'll allow the originator to lock in the loan. And that's going to happen in both retail and it's going to happen in wholesale. Again, there's going to be people that do it quicker than others. We just saw Quicken do this recently with the areas that are shelter in place, but that's just kind of inching their way towards where they will ultimately go, where everybody will ultimately go, which is requiring a loan approval to lock in a loan. And I know that is not what we're used to, but due to the volatility, due to the extreme movements day to day, the margin calls, pipelines moving, consumers losing their jobs, lenders need to be in a position where they have a committed borrower that is qualified, that has a job, that can close before they can secure that rate lock, because there's such a financial burden if they don't. So this is going to happen also, guys. Again, we need to adjust right now. These are extreme times, and we need to understand extreme measures are going to be taken. And the best thing we can do is focus on our job, staying positive, staying productive, and adjusting as these things happen. Take the punches as they come. It is what it is. You can cry to the loan officer next to you. You can cry to the broker next to you. You can cry to your processor. Still not going to get you anywhere. The only thing we can focus on is how we're best serving our consumers, our communities, and supporting our business. And the only way to do that is these things are going to happen. Roll with the punches, deal with it, move on. A non-QM went away. You got to deal with the consumers who qualify for those loans. You got to deliver some really bad news, and it's unfortunate. Explain it, move on. Ginnie Mae is now cutting back, or the servicers that buy Ginnie Mae loans are now cutting back, and you're going to see the independent mortgage bankers that you either work for or broker loans to reduce their exposure to the market. You got to deal with it. You got to move on. It is what it is. This is going to be a part of more and more limitations that are coming in the future weeks. So think about it. Last thing I want to leave everybody with is just understanding that I understand there's pressure in the market. VOEs are an area where there's lenders are having their alternative guidance on how do you verify employment if the companies work from home or their office is closed down or you need to do it through some alternative mechanism. Understand there's never a reason to commit fraud. This is a very important thing. People are going to lose their jobs. Loans are going to go into default. And when they do, there's going to be investigations related to any defects with loans. You do not want to be the person that committed fraud. You do not want to be the person that instructed a consumer or the employer or anybody to commit fraud, meaning a person's currently has a job, but they're not getting paid because the company shut down. However that VOE is filled out transparently is the way the lender needs to view it. You can't take unnecessary risk. Fraud will be met with fines, with penalties, and with criminal authorities stepping in and coming after you. So I can't tell you enough. It's not worth it. It's not worth this commission. It's not worth this loan. Focus on the big picture. Stay positive, but don't compromise yourself. Don't put yourself in a position to be exposed to that type of risk and that type of liability. So everybody stay positive. These are challenging times. We're going to get through it. And I'm going to continue to bring updates to everybody on markets, on what's going on in lending, what's going on from a capital markets perspective. So keep tuning in. I appreciate everybody's support. Have a great day. Talk to you soon.